Most traders think you need big money to score real wins trading options, but that's just not true. Over the past month, I used $500 in a repeatable options play to make 450 without taking big risks, just smart trading. So let me show you exactly how this works and how you can start stacking small wins as well. I had my cash tied up in stock positions and I saw I was missing out on a market jumping higher. Every time a stock dropped, it bounced back up. And since I didn't have enough cash to sell more puts, I started selling put credit spreads, a strategy that lets you profit if a stock goes up, stays flat, or even drops a little bit using a lot less cash. Using the same $500, I moved through 6 different trades over the month and earned $750, almost hitting that $1,000 beginner benchmark with a single trading approach. But how do you replicate that kind of success in your own account? The answer: focus on one strategy only. And in this video, it's about put credit spreads. This will boost your odds, cut out costly distractions, and make it faster and simpler to win. Here's the easiest way to think about it. Getting a degree might help you land a job, but it doesn't necessarily teach you anything. You need real world experience. Watching YouTube videos are great, but it'll never allow you to bank your first $1,000 a month until you actually get hands-on experience trading options. So how do you do that if you're short on funds? No cash? Open a practice trading account and paper trade, making trades with fake money to build your skills. Have cash? I still recommend paper trading at least 20 put credit spreads before going live. Once you're ready, limit your risk to $500 per trade. When you combine education with your experience, that's when you'll start seeing real results come together. But how do you stay motivated to push through the I suck at this phase? Well, let me show you. I used to think a 9 to 5 was my ticket to freedom until I opened up my first pension letter. It basically said work for 40 years and maybe you'll have enough to retire. That was a gut punch for me, and I realized right then and there, nobody else was coming to save me. That moment fired me up to learn a different, albeit more challenging way to secure my financial future. Then this skill of self-reliance is a critical one in life and in trading. At the end of the day, it's just you versus you, and I know you don't want to leave your future in someone else's hands. If you're here, it's because something inside you knows you deserve more. When you hit setbacks with your trading, remember your why. Use that fire to push through. And now that you're all jacked up, let me show you how to use your stock chart to pick the best time to enter into a put credit spread. Remember what the Chicago Bulls were like before they got Michael Jordan? Neither does anybody else because they were bad. They drafted his airness and then started to win, eventually topping out, winning 6 NBA championships. After MJ retired, the team was broken up and there was a steep decline. The stock market works in similar phases, and you'll only want to play in the best ones to win with credit spreads. Here are the 4 phases. Number 1, basing. The stock moves sideways. This is a good time for put credit spreads because time or theta decay works in your favor, and you make money as days go by and the stock doesn't have to move all that much. Phase 2 is advancing. This is when the stock is running up, and this is the best time for put credit spreads. There's positive momentum and sentiment. They're both on your side, and I've picked up my last 3 Tesla wins during this phase, especially buying dips in the uptrend. Phase 3 is topping out, and this one is tricky. It can look a lot like a pause before another move higher, but if the stock starts to nosedive, your put credit spread can lose fast. Avoid trading in the topping out phase if possible. And phase 4, declining. Never sell a put credit spread in a downtrend. You will lose money and it will not be worth the stress. Wait till the stock starts basing again and then look to get back in. Just keep targeting the basing and advancing phases and sit out the others. Or if you really want to trade, find a different stock that's in phase 1 or 2. Now that you know when the best time to sell a credit spread is, how do you actually do it with only $500 and still win consistently? Well, it's a lot like when you're driving. Every time you switch the radio or peek at your phone, you risk drifting off course. But if you laser in on a single trading strategy and repeat it, you'll grow your skills and profits faster. Here's my playbook for selling credit spreads. First, always use monthly expirations. Weeklies force you too close to the stock price and long-term weakens the effect of time decay. Number 2, stick to a daily chart. This will allow you to spot the phase that the stock is in. 3, sell put credit spreads in basing or advancing phases only. Number 4, pick a 15 delta for your short put, the one that you're going to sell, for about an 85% chance to win. Number five, buy a put $5 lower to cap your risk at $500. This is how you create the put credit spread contract. Number six, aim for a 10% return. Get at least $50 if you're risking the full 500. Number seven, close the trade for a win when you reach 50% of the potential profit. Number eight, cut for a loss at 1.5 times your potential win. For example, if you're down $75 on a $50 profit target. Number nine, limit each spread to 5% of your account. If you don't have $10,000, narrow your spread to $4 or $3 wide to fit your risk. Stick to this system and you'll win consistently, even with a small trading account. And remember, nobody is coming to save you. It's all up to you. But if you want to speed up your progress and skip the rookie mistakes, book a private coaching session with me using the link below. And if you want to know if you're getting close to winning with options, watch my next video for the 3 big signs your profits are right around the corner.